Welcome to Investors Insights. Our topic today is Finish the Job. We've got some great insight and information for you today from our portfolio strategies team here at Five Plan Partners, addressing rate cuts, rate hikes. What are the possibilities? And we think you'll find it of value as we start to march towards the end of 2023, going into 2024. I'm joined by my distinguished colleagues who I thoroughly enjoy working with, Bobby Norman and Ty Miller. And guys, the meeting this morning, really appreciate what you brought up in regards to rates, interest rates. Will the Fed go and cut rates? Will they raise rates? It's a big debate with our clients right now as some are holding off on purchasing certain things that are impacted by interest rates. So with that, Bobby, let's start with your data and then go into Ty to give people insight.
Yeah, so it was a great November for the stock market and the bond market, as the threat and the uncertainty of future rate hikes from the Fed have now actually turned into thoughts of rate cuts next year. And so while it was great to see market strength, and we actually saw market breadth for the first time last month, especially with the breadth widening out, we believe the market's timeline, though, for rate cuts next year is premature. And here's why. So looking at this chart, we, along with the Fed, know that history suggests a second wave of inflation could delay any rate cuts that are currently being discussed. In this chart, what it does is it looks at different times throughout the history where inflation spiked. And looking back at 1910, 1939, 1972, and 2019, we actually saw a second wave of inflation. And the Fed has made it clear that they are committed to finishing the job. So rate cuts might be further out than investors are expecting. And so we would like to see the market up for more substantial reasons, such as corporate earnings, a strong consumer, and not up just on the thought that the Fed will be cutting rates early next year, which, again, we feel is premature based on previous waves of inflation.
Yeah, no, that's excellent insight. And it's going to be a big debate going forward into the 2024 year. And Ty, then you added to this, really liked what you showed in the futures market. Elaborate on that.
Yeah, so Bobby talked about a timeline for rate cuts. And as you can see in this chart, that timeline reflects for the prediction for the Fed funds future rate is 4 rate cuts going through next year. So go from where we are currently and then 4 rate cuts of 25 basis points. Now, when you look in this chart, it looks like a lot more than 4 cuts, and they're not really in 25 basis point increments. That's because this Fed fund rate futures market is really just the predictability, the likelihood of a cut. It's not necessarily saying this is what the rate's going to be on this specific day. It's saying the odds are that this cut, a cut will take place at this time. The likelihood of the rate being lower at this time is higher or lower at that given time. And so, again, as you see here, where we currently are, predicting a full 100 basis points or 1% rate cut till the end of next year. And as you can see in this chart, a hold is kind of a perfect time period for the market. We really prefer the Fed to hold as opposed to cut. The S&P performance is significantly better. It's kind of a Goldilocks environment as opposed to hiking or raising. And so, according to the last chart, we think that hiking is over with. But as we go into this cut period, as Bobby mentioned, if we can prolong those cuts, we do think that would be better for the market in the short term. As you see in this forward 6-month performance, holds are significantly better than cuts.
No, well said. So folks, understand this. As Ty and Bobby have just discussed, we don't necessarily have to have a rate cut for things to continue to get better. The market can react positive if rates remain the same in this time period. But it's going to be a debate. We're going to keep you updated. We also will continue providing you information through all our social media outlets in terms of LinkedIn, Twitter, Facebook, in terms of YouTube, our podcast. So please continue to give us feedback. Also, we love for you to ask us questions to bring up in this vlog, as well as our social media information that we can provide. So don't be shy about that. I also want to thank those of you who have been sending our blog to others. We've developed some really nice relationships from that with people that wanted to receive this kind of information, and they hadn't been receiving it from their current financial advisor. So keep us in mind for those things as we approach year end. It's hard to believe in just a few weeks, 2023 is over. And we thank you for believing in us. We thank you for the trust and confidence you placed in us. And we will continue keeping you informed over these next few weeks. Have a great week. Look forward to talking to you soon. Thanks.